Hi guys, welcome back to my channel. Kelvin here. As you can see, we have a very special guest. His name is Josh Tan, and I believe that he doesn't need any introduction. He is one of the leading OG financial YouTubers in Singapore. And anyone who is in Singapore learning about investing will have definitely came across his channel, right? Yeah, so Josh Tan, I have one question for you. Like right now, you're posting like 2 to 3 videos a week, right? While having a full-time job, while having a kids, and occasionally you write books on your side. So how exactly do you find the time to do everything?
Actually, I like that title OG, it's like we very lao jiao like that. But it's true, it's true. Back a couple of years, Singapore's YouTube scene was still budding, correct? Like a few years back, everything was still very raw. We were still looking a lot at US. So now it's like a few years later, we suddenly become the OG early people who came into the scene. But back to the question also. So, I guess it's hard to balance quite a few things. It's like school days. We have final year project, and then we have assignment not completed. So it's all about focus. So, it's really back to handling a lot of things, multitasking. And at the end of the day, it's also big picture wise what you want to achieve. So in this journey, I guess I had to also pull back on some things such as, no more mahjong nights, kind of thing, just to make sure that work can be completed, children can be, well taken care of and stuff. And I guess also for your own, you also realize there's a fine balance, right? Like kid and YouTubing. How is it on your side?
Right now it's much better actually because it's considered my full-time job right now. So I work I still work insane hours, like 5 to 6 p.m. 5 a.m. to 6 p.m. So yeah.
It's not on focus, correct? It's like what you want to achieve, correct? Then you hold yourself to some standards. Then that's how we keep moving each step forward. I guess anyone hearing this can, take this advice from both of us also. It all takes baby steps.
Okay, yeah, moving on. I think one of the biggest thing that both of us are facing now and many other people is that our portfolio is super red. But how's your portfolio doing right now?
The portfolio performance, right? It's a accumulation of choices. What do we choose to buy? Whether it's stocks or a diversified approach, funds, ETFs, and more importantly, also is when we chose to buy it. Because if you bought it at Tesla at January and you buy it now, it's very different. The P&L will look very different. So it's also when we chose to enter. Right now, it's looking okay on my portfolio because I have commodities. It's been staying high. They're still very unpopular. And if you check around, you see REITs, small cap Singapore names, relatively strong. But having mentioned to that, I also bring upon a point that, Jack Ma has mentioned before. When people say Alibaba is doing very well, very well, he also mentioned that, the phrase goes like, if I can remember correctly, 成功是短暂性的，并不意味你未来会成功, which means also that what we see now in terms of good results or success, it doesn't guarantee the future also. So we bring that logic to always be humble, treat Mr. Market with some respect. So in that sense, how it's performing now, we cannot assume it will do well forever. And even if it's not performing well, I think there'll be times where it will start to reverse also.
Yeah, I think the important thing is about to focus on the long term. Short term doesn't really matter because we don't need the money now.
Correct. So that point is very valid. If you invested monies that you need it end of the year, then you would have that nervous feeling, correct?
Yeah, just now you mentioned about commodity. One thing I find very interesting is that while everyone is talking about Tesla, Alibaba, your biggest holding is actually in commodity stocks. In one of your videos, you mentioned it's around 30%. So why commodity? Like, has it always been there or is it just a short-term player?
Last year's biggest allocation, I've shared before on the channel, so was Propnex. Quite simply, Propnex is the biggest property agency in Singapore. They do commissions. That means they earn commissions through transactions. But I also chose to believe that, now is a high cycle in our residential property market. And therefore, I fully exited Propnex from last year's biggest holding. So the question is, this year's biggest holding, yes, indeed, is commodities. I've only invested, starting from this year, heavily into this segment because while commodities have been underinvested for years, the war has been a big catalyst. Because if you check around data, you realize that, for example, Russia is the second biggest exporter of crude oil. They are one of the biggest exporters of LNG also. Russia and Ukraine also export sunflower oil, the most in the world. And sunflower oil itself is the second biggest consumed cooking oil. So in a lot of ways, there are severe problems actually in terms of agriculture, in terms of energy, and not to even mention Ukraine and Russia provide a lot of wheat and soybeans to Europe and Africa. So the problem is acute. And rather than complaining at the hawker center, hey, the food prices are going up every day, why not own some assets that directly benefit when agriculture goes up, when food cost goes up? So that's how I approach things. And I think you also mentioned just now a question on whether it's a short-term play, you know. Correct. Let me give some context to things also, because in my work, I started financial advisory many years back. And I remember back in 2010, there were a lot of commodity funds. This month got one JP Morgan fund, next month got one Schroeder fund. And it's a bit like what we see now in terms of robotics, AI. This is the hot theme right now. And back then, it was all about commodities. Because China was ramping up industrialization, and there were a lot of logical factors. Chinese people getting wealthier, they're eating more meat. That's why even soft commodities were going up. But I also like to suggest to think very critically. When things are hot, they may or may not return good returns. And when things have been beaten down for years, that's where if you think contrarian, you might see a big payout, more than what market has expected. So that's a bit on how I practice my approach, and therefore I've allocated big amounts to commodities for this year only.
So I think one of the big questions that everyone has right now is that, are we at the market bottom yet? Like last week, the S&P 500, they rallied quite a bit, right? Yeah, what do you think? Can it go down more? Is the apocalypse over already?
I'm a bit more bearish than most on the tech. I think I've sounded that. Whether it's right or wrong, only time will tell. In my opinion, actually, that tech has been quite bullish. There's a lot of factors that can support that argument. There's specs. There's very little regard for profits in view of earnings growth. So we go down more. I think let's put some numbers to things. Maybe that can help our audience together to understand. Right now, if you look in terms of price earnings ratio, S&P is at 22 times. And if you look in terms of history, right, the average is about 15 times. So is this depressed? I think it's hard to say it's super depressed also, because we're not even average. And typically when market declines, it can even overshoot on the average, which means it compresses all the way down to 12 times, 10 times. That's where you really see the argument of a big crash coming about. Not that it's going to happen, not that we are seeding fear and stuff. It's just me trying to explain what does earnings compression really mean, and why do markets tumble so badly? If you research based on .com crash, that's a different scenario. There were no earnings then. Or if you look in terms of global financial crisis, why do prices drop so drastically? Because expectations drop, earnings drop, and therefore you see markets really marked down in terms of what they are willing to pay for a company's price.
Yeah, actually, I have the same sentiment. After researching through, I believe, all the factors that are causing this crash, inflation, interest rate, commodity price going up, the war, all of these factors are still here. And unless some of it gets resolved, things may not improve in the short term. That's what I feel.
So what's your thinking about market bottom?
So I was checking out what's the average length of a bear market. Right now, we are not in a bear market yet. A bear market is a drop down 20%. So we have right now dropped about 19%. So we are not there yet. But if it does happen, a drop will usually last around 11 months. So if it does happen, we can probably see this lasting until end of the year or early next year. That's just based on past data. I'm not saying that it will happen. Yeah, just based on past data. So let's see.
I'm also afraid, when many who are viewing some of the content that we have shared, they are expecting the same bounce they saw in terms of March 2020. That bounce was catching everybody off surprise. And it's very atypical of a bear market. That was a flash crash, more of a panic sell, and then it rebounded.
I would say that the bounce was caused by the Fed intervening by announcing unlimited QE and all those stuff. If they hadn't done that, I believe the crash would last a lot more longer. Yeah.
Correct. So this time around is very different, man.
Yeah, this time is very different. I can't see anything happening unless Putin decides to stop the war tomorrow. Then it will definitely be over.
You know, on my channel, I became very interested in the war. I digged up all the data on World War II and stuff to really understand, what could happen. And that part on Russian war, maybe I can drop a bit on what I've discovered, is that right from the start, I realized that it's going to be more long-lasting than many expected. Many expected war, then after that, quick ceasefire, a resolution that comes out. But as we see, we're now 3 months in already. There is no way that there is going to be a settlement that both sides can agree on, just to put into simplistic terms. In our opinion, sooner or later we get so used to that war noise. But this war problems, especially links back to commodities, would be longer lasting than I guess many would have expected, because the wheat is not going to come out from Ukraine anytime soon. The ports are all locked down. Farmers are having problems exporting, even if they can plant. And if we were to guess it correctly, Russian energy will be probably off the markets for foreseeable years ahead. That's how I came to realize that this commodity play may be not a temporary one. It could be longer lasting. That's why, Warren Buffett has also allocated to Chevron and Oxy and stuff. But again, depends on your comfort zone in investing the beaten sector.
Yeah, it's also important to invest into stuff that you understand.
Yes. And I guess many are concerned that they can't predict, commodity cycles. We don't know whether oil will drop.
Yeah.
That's the biggest fear. Like, call it to invest into energy ETF, for example. You don't pick names, you buy a whole ETF. But many are concerned whether oil will go back down to $80 or even lower. I think that's where we are actually still relatively early in this commodity super cycle. Most have not came to consensus that oil prices will stay high for years. So once market has that consensus, then again, we'll be pricing things very differently.
That's the question. A while ago, there's someone saying that we should stop buying and buy after the market has gone down. But I would go one step further and say, if you believe that the market can go down more, why not just sell everything? Then we buy like a few months later when it's cheaper, because all of us are bearish now. We believe that the market can go down. Like, why not do that instead? What do you think?
The first reaction is confirm bad idea. That is to sell everything and then buy back, hopefully at a lower point. Confirm bad idea. Why do I say so? The first is, if we get it wrong, you think about it, which means if we, for example, in March 2020, we thought you'll go lower, correct? You sell out and you realize you missed out on everything. So you could get it wrong. That's the first thing. But the worst part actually is, if you get it right, what will happen? That means that you would be reinforced with this market timing bad habit, actually. Correct? That means you'll be doubling down. Oh, it's going to you believe that you understand the market direction 100%. So it's going to reward you to double down on a future bet, which you'll get it wrong at some point. It's like, casino, you put one, you take ta, and then it's correct. Then you have that overconfidence, and you double down in future and you'll get caught at some point. So my point of view is, even if we are bearish, the reaction, especially when we're all young working adults building up wealth, is to moderate your buying process. You can slow it down. You can dollar cost average. There are a lot of ways to handle your accumulation. Whatever you're bought, unless they are bad ideas, they have a change in terms of their fundamentals, then that's where you exit. If not, what you do is to handle how you approach buying the market, moving forward. Rather than what you have, you sell and buy, that's fully market timing and proven to not be rewarding. So definitely avoid that.
I think everything makes sense only in hindsight. You can say you can time it maybe this time, but probably not the next time, and you will just return back whatever you gain.
It feels shock to be able to guess and get it correct. But what we want when we invest is to get results, right? And we have to listen to data, which suggests that market timing really doesn't pay off. You would get it wrong at some point of time. And even if I'm so bearish, as you see right now, I'm not shorting the market and stuff. That is not the right approach. I'm only moderating how I'm buying or what I'm buying. So that's hopefully some suggestions to viewers.
Yeah. So in the video, right, you mentioned there's severe anchoring bias for all-time high US equity and tech. So what I mean by that is that you say that it has dropped from the high over a few 10-20%. But what point would you consider that tech stocks are cheap? Like, as in, what is the metric that you will look at?
I think the severe anchoring bias also need to give some context to it. Because, when we create content, we cannot sit on the fence. So we need to drive home our point of view. So maybe severe part is really to emphasize and draw attention to my point of view only. I do believe anchoring bias comes about because we are all so used to all-time high. When we hope to make profits, we are always hoping that things revert back to what it used to be. And then we don't see that situations have changed. So just now we were thinking, at what point we become cheap enough? This is, in my opinion, a deflation of tech. Quite difficult to hear. I hope most don't slap us on the comment sections, but it's my point of view that right now tech is deflating. It's outperformed for many years. It's normal actually for something to outperform and then underperform for years. So if you check on history, you realize that has happened many times before. So in a bubble deflation kind of a scenario, it's hard to put a number to things. So when is cheap enough? Because just like you mentioned, when is cheap enough to re-enter the market? It could take some time. And the best gauge is sentiment, real market pessimism. In Chinese tech right now, you would see people laughing at people who are long Chinese tech because it suffered for years already. That could be a scenario where you see extreme pessimism. It's not a month-to-month thing. It's real reinforcement after a year or two. And then that's where we see extreme pessimism. So maybe then it will be when I'll look at tech a bit more.
Speaking of cheap, I saw that you mentioned that Tesla is possibly cheap now. Yeah, and maybe that's because you are valuing Tesla at PEG instead of PE ratio. So welcome to the family. But have you really started buying Tesla right now?
Maybe I explain a bit. So I put there, if you see carefully, it's not expensive. So
Right.
I also dare not call it cheap because it's also hard to justify it's cheap also in many ways. And market is very humbling. This is a good point. Because the moment I thought, hey, Tesla at 1,000, I even was measuring Tesla at 1,000, if you look at it correctly. I even thought it probably not expensive because previously I was calling expensive. With latest earnings, I realized hard to justify it's expensive. But the moment I posted a video, you see Tesla shares corrected massively. So it's market is very humbling. You never know. Your point of view can get wrong, and most important is to survive when it's wrong. But also, why did I mention it's cheaper than when I created my first video back in January 2021? Because back then the earnings were not coming through yet. Right. Fast forward 5 quarters. I guess your channel has a lot of Tesla fans. Everybody's aware that the earnings have ballooned up massively. So in terms of cheapness, we also need to validate if there's earnings that have came through, that's where we have concrete, not fluff, just real concrete earnings, profits. And then that's where we need to reevaluate the TCs. And the PEG method is a method to see growth companies. This was actually mentioned by Peter Lynch actually. So how we measure it is, for example, Apple. Apple has forward earnings 20 times, but you look in terms of quarter-to-quarter growth, it's only about 10 plus times. Whereas Tesla at 50 times forward price earnings could have a growth of profits that is in excess of 50%. So again, the PEG method values growth companies that are profitable. And by that context, that's how I came to a conclusion. Tesla is not expensive. But your question is whether I'm in the family. Not yet.
What would change your mind about that cheapness? When will you say that it's not cheap anymore?
Earnings. Let earnings dictate how we value the stock. Fair enough. Which means there is a lot of possibilities. I understand. I guess your community already understands the big possibilities. But if we look at the numbers, just purely value based on numbers, if earnings grow even bigger, then that's where it will look increasingly cheap. But if first quarter was just a big jump and then subsequently it flattens, and that's where we need to reconsider. But my view of US tech is a big picture view, which means I probably won't be diving into it anytime soon. And I also share on my channel, even though I believe there was a bounce, I decided to to buy the index instead for the bounce rather than buy individual, just to simplify the approach lah. So that's how I approach things. I want to ask you a question. So you have you added more Tesla positions? Maybe you can hear a bit from your point of view.
Right now, Tesla is about 86% of my portfolio. I know that's very bad. That's very bad already. So what I'm doing is I'm taking this chance to consolidate my positions. All my other stocks are Square, RK, ArcG, all of which have dropped by a lot since last year. So what I'm doing right now is I'm trying to slowly sell off those positions and use the money to buy safer stocks like Google, Amazon, Apple, Microsoft, those kind of stocks. So they are already well established. So I believe that they'll be here for a long time. I won't be selling my Tesla stocks, even though they are such a high percentage.
You instead build other positions to space it out the weightage.
Correct. So that it will reduce my Tesla percentage. Yeah, because I realized that in the beginning I was going so heavy is I'm chasing the return. I'm chasing that kind of 50% compounding return per year. And I realized it's quite foolish. just put it that way. I believe that slow and steady wins the race lah. So now I just trying to reduce the percentage, make the portfolio safer as I go along now.
I think I can add a bit in that context also. While investing very concentrated can build your wealth very quickly, we also need to weigh. When you invest, you are investing for your financial future, your family's financial security, correct? Which means we don't need to get the best return in the world. We don't need to make astronomically big bets or concentrated bets, because what we want is to get to financial freedom or have a surplus. So once we weigh that priority, right, which means I want the security, I want to make sure that I can get there, then you realize there's no need to concentrate too much. And I do agree. If you are chasing to be the world's best investor, then yes, concentrate everything. If you are really concerned, okay, I need financial future, then it makes sense to, like what you've done, space it out a bit, or even space different sectors, because Google and Apple are still in the same tech sector. They would correlate with Tesla's performance in many ways. So that's some things to think about for anyone that's viewing also.
Yeah, so let me provide one more thing. Many people see that Chicken Genius, his portfolio is like 90% Tesla. But what they don't realize is that he has another portfolio. I'm not talking about the itchy fingers portfolio. He has real estate. He has a business. So actually, even though his stock portfolio is like 90%, it's just like, if you take into account every single thing, right, it's probably just like 30-40%.
Oh, 30-40, okay.
Just a rough gauge. I don't know his exact level. Yeah, but still he's also diversified. But most people think that he's concentrated, but actually he's diversified. He has already the safety net of all the other stuff like property, business. That's why he can go so hard into Tesla. But for people like us, we have only a stock portfolio. So that's why it's a bad idea, I feel.
Understand. Yeah, I think it's a very valid point. Assets wise, yeah, add in real estate into the portfolio. That would definitely space out your risk.
So final question, you have been actually investing for a very long time as a 老教. Any tips on how we should invest during these scary times?
Maybe the scary feeling is when we see the portfolio drop, when we see negative news. And in a lot of ways, if you think about it, right, it's like, you know people who do rock climbing. Some people can climb all the way to the top, but I cannot. I climb halfway, I look down, I get scared. There's a few reasons, because I haven't climbed enough. I'm not very sure of the safety harness that's holding me. So I'm scared that it gives way and I'll drop and I'll get hurt. But for those people who have climbed, the rock climbing wall many times, they trust the safety harness. They've been there, they've dangled in mid-air, but they realize that it doesn't kill them, even if they miss a step or they climb higher and they need to dangle. So that's the same logic. Scary times, especially if you're new, then get advice from people who have seen through market cycles, you realize that they did not die from the previous market crash. Global financial crisis, once you've invested through that, you realize bear markets can last very long. It will take the soul and heart of investors. But at the end of the day, you see things will recover. So on my channel, while I'm sounding a lot of pessimistic views, it's also for this moment. While I believe things would not look too good, but over the long term, we also need to believe that we are safe if we invest in things that we believe in, or it's diversified. It doesn't get to zero, and then you get used to it, like that scary feeling. So for any new investor, if not sure, then diversify better. Buy the entire index. If you like tech, you just go NASDAQ as a broad-based index. Then hopefully that can remove or reduce some of the scary feelings, because that will never get to zero. But as a particular company, we never know.
Thank you for the advice. I think it will be certainly useful for everyone who is investing right now. And I believe that most people have just started recently, especially within these 2 to 3 years. This will be their first real bear market.
So maybe I can share. So in 2007, end of 2007, I was a young chap. So I'm not that young nowadays. 2007, I was also making profits because back then it was not US, it was Asia. Asia was growing very fast. So I was trading stocks as a uni undergrad, making some extra income from there. Then I got overly aggressive. Then I got into margin. So from 2007 to 2009, it was hard. I was on margin calls. I lost money and stuff. But I also realized that, if you can survive a crash that is 17 months long, that whole downturn, you realize that things will eventually turn to sunshine. It's to survive. In bear markets, it's really to survive. Don't worry that there'll be no sunshine. Worry about how you manage your emotions. Are you too invested? If you are too invested, then you might need to hold back or slow down, even though valuations are cheap. It's more about survival. It's not cheap. Then you just borrow and keep margining it in. It's not the best way. So it's about survival. If you have overly invested, then slow down, build up your cash, reduce the margin and stuff. There are other ways to approach it. You survive it, you get out of it. The next round, you are a lot more savvy.
Yeah. So once again, if you have not subscribed to Josh Tan yet, do check out his channel. He posts 2 to 3 times every single week. And he also has a second channel. Wow. I don't know how you have the time to do that. I'll be leaving the link to his channel down below. Anyway, Josh Tan, thanks for joining me in this interview.
Thanks, Kelvin.
I'll be seeing you again. Bye.
Yes, we catch up. You take care.
Okay.
Again. Bye-bye.